Now we will look at several financial statement analysis techniques that have been discussed in this reading. The first is DuPont Analysis. DuPont Analysis decomposes ROE or return on equity. This is net income divided by equity. So this is decomposed into components. The most basic decomposition is to say that ROE is equal to return on assets, which is net income over assets, multiplied by leverage, which is assets over equity. Now, you might have a company that has a high ROE, but that high ROE is coming because of leverage. That will be a cause for concern. Then we can break ROE into three components. So we can say that ROE is net profit margin, so that's net income divided by revenue, multiplied by asset turnover. Asset turnover is revenue divided by assets, multiplied by leverage, which is assets over equity. So notice here the revenue cancels, assets and assets cancel, and we are left with net income over equity. So here again, we can see whether ROE is coming because of high profit margins, or is it coming because we use our assets very efficiently? An efficient company will have high revenue relative to assets, or is the high ROE coming because of leverage? And then net profit margin can be broken into three parts. Net profit margin can be high because of the operating margin, or because taxes are low, or because interest is low. So this is the five-way decomposition. Asset turnover and leverage are the same as what we have up here. Evaluating the different components of ROE allows an analyst to identify a company's potential strengths and weaknesses. So for example, based on this analysis, an analyst might determine that the ROE is high because of leverage. That is a potential weakness of a company. DuPont analysis should be performed with and without the impact of income from associates. This is because the operations and resources of associate companies are not in the parent company's control. The next point has to do with asset base composition. Here, common sized balance sheets are used to examine the change in asset base composition over time. So what we are looking at here is each asset as a percentage of total assets. So for example, we might look at what's happening to accounts receivable over total assets, and we look at this ratio over time. If this ratio is going up, that will be a cause for concern. Another area that we look at is goodwill divided by total assets. If this is going up a lot, that will also be a cause for concern. Capital structure analysis. We should use leverage ratios and liquidity ratios to evaluate changes in capital structure of a company. In particular, we should evaluate whether the capital structure is becoming riskier or not. So for example, let's say we are looking at debt over equity, and if debt over equity is increasing over, let's say, several years, then this will be a cause for concern. Segment analysis and capital allocation. An analyst should perform a segment analysis and understand how the company allocates funds to different segments. Obviously, this is relevant where a company has multiple segments. For each segment, we should compare the EBIT margin with the ratio of total capital expenditure percentage to total assets percentage. Now let's understand what we mean by this ratio. Say we have a company with two segments, A and B, and in terms of expenditure, the expenditure on A is 40 and the expenditure on B is 60. In terms of assets, let's say the assets allocated to A are 500 and assets allocated to B are also 500. Now, with this ratio, we are looking at the total capital expenditure percentage divided by total assets percentage. So let's take segment A. The expenditure percentage for A would be 40 over 100 because total expenditure is 100. So for A, we have 40%, and this is divided by the total assets expenditure. The total assets expenditure for both A and B is actually 50%. So for A, we have 500 over 1000, which is 50%. So this particular ratio that we are talking about for A is 0.8, and for B it's going to be 60% divided by 50%, which is 1.2. So this gives an indication of how much expenditure is happening against each segment. Now, this expenditure should be compared with the EBIT margin. And the point being made here is that segments with high margins should receive a relatively high capital allocation. So, for example, if you look at the margins for A and B has a relatively higher EBIT margin, it will make sense that a greater percentage of the expenditure is allocated to B. But high EBIT margin does not necessarily mean that a segment is doing well from a cash flow perspective. So in addition to the EBIT margin, we should also estimate the cash return on assets across different segments. Moving now to accruals and earnings quality. Earnings can be separated into cash flow and accruals. The accrual ratio can be estimated using a balance sheet approach or a cash flow approach. So in very simple terms, we might have a company with net income of 100. Some of this net income, let's say 60%, might be coming because of cash, whereas the other 40 might be coming because of accruals. Now, the higher the accrual percentage, the greater the concern, because when we have high accruals, that's not very sustainable. So there are two ways of coming up with the accrual ratio. One is the balance sheet approach, the other is the cash flow approach. With the balance sheet approach, we take the change in net operating assets over a given period of time. So let's say this is the start of a period, this is the end of the period. We look at the change in net operating assets and then divide by average net operating assets over this time period. Now the question is, what is net operating assets? Net operating assets is our operating assets minus operating liabilities. In very simple terms, operating assets will be total assets minus any cash and marketable securities. So let's just put that as cash and marketable securities. So this difference gives us our operating assets, and then operating liabilities will be liabilities such as accounts payable and so on. So in simple terms, this will be total liabilities minus any interest-bearing liabilities. So any loans, whether they are long-term or short-term, where we are paying interest, would not be operating liabilities. So those interest-bearing loans are subtracted. That gives us our operating liabilities. And the difference between these two is our net operating assets. So the point here is that if the change in net operating assets is high relative to the average net operating assets, then that means that the balance sheet accrual ratio is high, and that is not a good sign. With respect to cash flow accruals, we look at the net income in a given period, and from that we subtract the cash flow from operations and cash flow from investments. So that's our numerator. The denominator again is our average net operating assets. If this number is close to zero, that's a good sign, because that is saying that our net income is roughly equal to the cash that we are getting. So if this is zero, that would mean that the accrual ratio is zero, and this would imply that accruals play little or no role in the financial performance of a company, and the earnings are of high quality. On the other hand, if this is a substantial number where we have a net income, but that net income is much more than the cash coming in from operations and from investing and from CFI, then that will be a cause for concern. Moving on to cash flow relationships, we should look at cash flows from operations and compare these with operating profits to determine if earnings are of high quality. Other cash flow ratios such as cash flow interest coverage ratio can also be used in our analysis. So the idea here is that if we have a company where the net income is going up, but CFO is flat, now this will be a cause for concern, because if our cash flow coming in from operations is flat, why is the net income going up? The only reason this would be going up is because of accruals, and that is not sustainable. Decomposition and analysis of a company's valuation. When a company has significant investments in associates, The price to earnings multiple of the pure company should be calculated by removing the impact of associates and using adjusted market value and net income. So the point is we are calculating the price to earnings ratio. The price will include the impact of investments in associates, and the earnings will also include an impact from associate companies. So the point being made here is that we should adjust the price as well as the earnings to come up with the price to earnings ratio of the pure company without the impact of the associates.